Today we're diving into a fresh take on the AI boom straight from Asia. Dan Ives, global head of tech research at Wedbush, just went on CNBC's Fast Money and said it plainly. AI demand in Asia is surging. I'm going to roll that clip for you first. Then I'll break down exactly what he means, why it matters for investors like us, and after that, I'll share my in-depth analysis of 2 AI stocks to buy now and hold for the long term. If you only watch one video today, make it this one, and stick with me to the very end. Before we jump in, smash that like button, let's hit 1,000 likes, share this with a friend who's watching the AI space, and drop your thoughts in the comments. And if you're new here, subscribe so you don't miss the next big investing update. Alright, let's hear what Dan Ives has to say.
Dan Ives out with a new bullish note on the AI trade as he's been conducting his channel checks in Asia. He is the global head of technology research. He joins us from Hong Kong. Good morning to you, Dan.
Great to be here.
So what you found supports the bullish case for AI? Is that what you've been finding?
Yeah, I'd say overall in the region, look, demand to supply for NVIDIA chips, it's about 10 to 1, potentially 12 to 1. Look, we do these trips, 3-4 times a year. It's about what demand looks like in the region from production. It's the use cases that are driving it, but it comes down to on the hardware side, right? And that's super bullish for NVIDIA. I think Street's underestimating numbers by anywhere from 20 to 30% next 12 to 18 months. And most of what I think this also means is like on the hyperscalers, in terms of everything we've seen from Microsoft, from Google, from Amazon, obviously Oracle that you saw today. I mean, we're only in the second inning of this all playing out. And all of our checks are just giving us more and more bullishness that this is going to continue. I think Street's underestimating it.
So, Dan, can you elaborate on where you're doing these channel checks? Because if there are export controls, which chips are you talking about? Where are these channels that you're checking?
Yeah, I mean, if you look, especially in Taiwan and what we're seeing, from NVIDIA, I think it all comes down to what does demand and supply look like. Now, you have the controls in terms of China, and that continues to be a question mark. But my view is that what does demand look like in the region? And I think what I compare it to even 3 months ago, it's probably up 20%. And I think what that shows that this demand that we're seeing across the region, especially from a production perspective, you can't argue with the demand. And the demand's being driven by the use cases. It's being driven by, obviously, big tech spending. But I think if there's a sort of a headline here, it's not slowing down. I think CapEx is going to be significantly underestimated now going into next year. And that's bullish for NVIDIA, bullish for AMD, bullish for TSMC, and of course on the hyperscaler side. And then you look at names like Palantir, Snowflake, Mongo, the consumption use case plays. That's where I think those continue to be just, pound the table as a broader group.
Hey, Dan, I hope you're doing dim sum for breakfast because that's how...
That is breakfast.
I know, but I had to go to Hong Kong to learn that. So I hope you're enjoying breakfast. Question about Huawei. What are you hearing there? What are you hearing about the chips that they're, basically creating to compete with NVIDIA and ultimately AMD? And, we're in a situation where they basically have import controls right now. I'm just curious, what the vibe is out there.
Yeah, it's a huge opportunity for Huawei, right? I mean, especially what's happened with big tech in China. And they're trying to narrow the gap. I think there's still, if you look where NVIDIA is globally, I think that continues to be the chip everyone wants. But look, it also speaks to in our Ives AI30, we have Alibaba and Baidu. I think those are going to be 2 names from a China perspective, specifically Alibaba, that is in a prime position for that to accelerate. But it just shows, look, this is an AI arms race playing out. And that's bullish from an investor perspective on both sides, whether it's China or US.
Here's what we just watched and why it matters. Dan Ives is fresh off a multi-stop tour in Asia doing channel checks, basically on-the-ground conversations with manufacturers, suppliers, and ecosystem partners. His takeaway is simple, but huge. The AI build-out is still in the early innings, and real-world demand is outrunning supply by a mile. First, the headline number everyone latched onto: demand for NVIDIA's AI chips outstripping supply by roughly 10 to 1, maybe 12 to 1. Even if you haircut that, it's an eye-popping gap that tells you 2 things. 1, hyperscalers and large enterprises are still scrambling to secure compute capacity. 2, the investment cycle hasn't crested. We're not in late stage. We're in what Ives calls only the second inning. That framing matters. If you've been wondering whether the AI trade is getting tired, His conversations on the factory floors and with the assemblers suggest the opposite. The bottleneck is still hardware, not demand. He also drops a bold call. He thinks Wall Street is underestimating NVIDIA's numbers by 20–30% over the next 12–18 months. That's not a small tweak, that's a thesis. What supports it? The combination of A, hyperscaler capex stepping up, B, clearer enterprise use cases that justify that spend, and C, supply chain commentary that's stronger now than it was just 3 months ago. He says his read on regional demand is up roughly 20% versus that prior trip, so the trend line is accelerating, not flattening. If you're modeling this space, that acceleration input is key. Let's talk geography and constraints. He's doing these checks in places like Taiwan, ground zero for advanced chip manufacturing. The interviewer pushes on export controls to China, and Ives acknowledges that's a wild card. The way I hear it, yes, controls complicate the picture, but when you step back and ask, does demand in the region keep growing? The answer from his sources is still yes. That's why he keeps coming back to CapEx. He thinks 2025 CapEx is still being underestimated. If that's right, the spend isn't a one and done. It's a multi-year capacity race. Who benefits? He puts 4 groups in the bullseye. NVIDIA on the hardware side, still the chip everyone wants. This is the compute king argument. AMD as a second source benefiting from the insatiable demand and customers trying to diversify. TSMC as the manufacturing heartbeat that turns all of that design demand into wafers and packages. Hyperscalers, Microsoft, Google, Amazon, Oracle as the ones converting CapEx into AI services, platforms, and eventually margins. Then he widens the aperture from infrastructure to consumption plays, the companies that monetize once the compute is online and the models are running. He name-checks Palantir and Snowflake. Translation: after you build the AI factories, you still need to operationalize data, inference, and applications at scale. If the infrastructure story is innings 1 and 2, the data, 𝗗𝗟𝗓 application layer is innings 3 through 9. I want to pause on that use case phrase he keeps repeating. It matters because this cycle isn't just about building fancy data centers, it's about what those data centers are used for. Co-pilots in productivity suites, AI-powered search and ads, code generation, customer support, healthcare analytics, logistics optimization, and more. The stronger and clearer those use cases get, the easier it is for CFOs to greenlight more spend. That's the flywheel Ives is pointing to. Usage drives ROI, ROI justifies CapEx, CapEx expands capacity, capacity enables more usage. Now, the China angle, and Huawei specifically. The question was, what's happening with Huawei's homegrown chips under import controls? Ives has read, it's a huge opportunity for Huawei domestically because the gap created by restrictions invites local solutions. China wants to narrow the performance gap with NVIDIA and AMD, but he's also clear, on a global basis, NVIDIA remains the gold standard people want, so picture a bifurcating market. In the West and many global deployments, NVIDIA keeps its lead. In China, localized ecosystems push alternatives to reduce dependency. For investors, that means 2 simultaneous truths. U.S. suppliers keep compounding off hyperscaler demand, while Chinese platforms build with what they can source. Ives also points to Chinese platform beneficiaries. He mentions Alibaba and what sounds like Baidu, which fits the narrative. Domestic cloud and AI champions will ride local demand even if they can't import top-shelf parts. What about timing? He keeps anchoring to the next 12–18 months for the underestimation window. That lines up with several inflections, new chip cycles entering volume, backlogs easing but not disappearing, and enterprise pilots moving into production. It's also the window where we'll see how quickly the AI to revenue conversion happens at the software and platform layers. If those KPIs come in strong, usage growth, attach rates for AI SKUs, early margin uplift, his second inning framework gains credibility. Let me layer in how I'm thinking about risks, because a bullish setup doesn't mean blinders on. Supply normalization risk. If supply catches up faster than expected, and double ordering gets unwound, some of the 10-12x demand ratio compresses. The question is whether real end demand backfills as lead times shrink. Export control headline risk. Any tightening or unexpected enforcement kinks could whipsaw sentiment even if global demand stays hot. ROI proof points. Enterprises need to see productivity wins and revenue lift. If those case studies lag, CFOs can throttle spend in later innings. Competitive response: NVIDIA's moat is real, but AMD is a determined second source, and custom silicon from hyperscalers, TPUs, Trainium, etc., will keep pricing and mix dynamic. Back to the opportunity set. If I follow Ives's map, there's a stack to watch. Semis Foundry, NVIDIA, AMD, TSMC, driven by unit growth and mix. Hyperscaler platforms, MSFT, Google, AMZN, ORCL, driven by AI service attach and consumption growth. Data and AI ops, Palantir, Snowflake, driven by the turn it on and use it side of the curve. He also emphasizes that the checks are stronger now than 3 months ago. That's an underappreciated detail. It suggests the feared air pocket hasn't shown up in his conversations. Instead, the narrative is that CapEx expectations for next year remain too low in consensus models. If that's true, estimate revisions still have room to travel. One last nuance that I think is important. When Ives calls this an AI arms race, he doesn't mean hype headlines, he means budget line items. Arms races are about sustained, compounding spend to gain capability advantages. In practice, that means new data center footprints, power procurement deals, cooling investments, network upgrades, and a constant drumbeat of silicon cycles. That's not a one-quarter story, that's a multi-year CapEx arc, with software monetization catching more tailwinds each quarter. So here's my bottom line after digesting his interview. If you believe the checks, tight supply, rising regional demand, stronger momentum than a quarter ago, then the next phase of the AI cycle is still hardware-led, with software monetization beginning to scale. NVIDIA remains the bottleneck breaker. AMD and TSMC are key beneficiaries as the ecosystem diversifies. Hyperscalers keep writing the big checks, and the data application layer starts showing operating leverage as usage ramps. China remains a parallel track. Huawei and local giants push forward under constraints, while global demand keeps favoring NVIDIA for best-in-class performance. For us as investors and operators, the practical watch list is straightforward. Hyperscaler CapEx guides over the next 2 earnings seasons, NVIDIA AMD backlog and lead time commentary, TSMC capacity signals, and, critically, software consumption metrics tied to AI SKUs. If those dials keep turning the way Ives' checks suggest, then calling this the second inning may end up feeling conservative in hindsight. Now let's dive into the 2 AI stocks to buy now and hold long term. Let's kick things off with our first company, a powerhouse in the advertising world that most people have never even heard of but interact with every single day. I'm talking about The Trade Desk, ticker symbol TTD. Now, if you've ever wondered how an ad for something you were just thinking about magically appears on a website or your streaming service, there's a good chance The Trade Desk was working behind the scenes. They are not an ad agency. They don't create the ads. Instead, they've built a massive software platform that lets advertisers buy digital ad space in real time using data to make incredibly smart decisions. Think of it like a stock exchange, but for advertisements. It's what we call programmatic advertising, and The Trade Desk is the leading independent platform on the demand side, meaning they represent the buyers. This is a crucial distinction. They aren't tied to one specific ecosystem like Google or Meta. They operate across the open internet, websites, apps, podcasts, and most importantly, connected TV or CTV. This independence is their superpower. Advertisers love it because it gives them a neutral, unbiased way to reach their target audience wherever they are without being locked into a single walled garden. The real magic, and where the AI comes in, is how they do it. The Trade Desk processes an insane amount of data. We're talking trillions of ad opportunities every single day. Their AI, named 𝗗𝗧, analyzes all this data in milliseconds to help advertisers bid on the right ad spot at the right time for the right price to reach the right person. This isn't just about showing you an ad for sneakers after you search for them. It's about understanding subtle signals and patterns to predict what you might be interested in next, making the ads more relevant for you and way more effective for the advertiser. This creates a powerful network effect. The more advertisers use the platform, the more data the Trade Desk collects. The more data they have, the smarter their AI gets. And the smarter the AI gets, the better the results for advertisers, which in turn attracts even more advertisers to the platform. It's a virtuous cycle that builds a deep, durable moat around their business. Competitors can't just replicate this overnight. The data advantage is cumulative and grows stronger with every transaction. The Trade Desk is a digital advertising powerhouse valued at about $24.39 billion. The company posted earnings per share of 0.83 and at a price-to-earnings multiple of 60.12. The market is clearly pricing in strong growth ahead. Revenue for 2024 came in at $244 billion, translating to net income of $393 million, a reminder that this is a scaled, profitable platform riding programmatic ad tailwinds. One of the biggest growth drivers for the Trade Desk is the explosion of connected TV. As more of us cut the cord and switch to streaming services, the old model of TV advertising is dying. This video is brought to you by Value Stocks Investing Master Course. If you're looking to grow your wealth by investing in solid, undervalued stocks but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. Now, let's move on to a company that's using AI to disrupt an industry that hasn't changed in hundreds of years. Alright, for our second stock, we're shifting gears completely from advertising to insurance, but this isn't your grandpa's insurance company. We're talking about Lemonade, ticker symbol LMND. Lemonade is on a mission to rebuild insurance from the ground up with AI and a customer-first app. Think about the last time you had to deal with an insurance company, nightmare of paperwork, long calls, confusing policies. Lemonade is the exact opposite. Get a policy in 90 seconds, get a claim paid in as little as 3 minutes, all through their app, often without talking to a single human. It's fast, it's simple, and it's powered entirely by AI. They started with renter's insurance, homeowner's insurance. They've expanded into pet insurance, life insurance, car insurance. Their target demo, younger tech-savvy consumers underserved by legacy giants. So how does the AI actually work? Lemonade uses a chatbot named AI Maya for onboarding and underwriting. Maya asks a few simple questions while AI analyzes hundreds of data points to price risk. When filing a claim, AI Jim takes over. Jim reviews the claim, checks for fraud, and if approved, pays instantly. This automation is unheard of in traditional insurance. It gives them a huge structural cost advantage. Legacy insurers have thousands of brokers, agents, claims adjusters, massive office buildings. Lemonade replaces much of that with code. That lets them offer competitive prices and a better customer experience, fueling low-cost customer acquisition. Most growth comes from word of mouth and digital marketing. AI isn't just cutting costs. It's improving core underwriting. Every interaction becomes a data point feeding the models. Over time, their underwriting should improve. Better loss ratios should point to profitability. That's the long-term buy thesis. Another key part: reinsurance. Lemonade keeps a portion of premiums and cedes the rest to reinsurers to manage catastrophic risk. That stabilizes financial results for a young company. They're rapidly expanding product offerings. Lemonade Car Launch opened a much larger market. Their funnel: land customers with renters, then cross-sell as they get married, buy a car, buy a house. This boosts lifetime value. Lemonade carries a market cap of roughly $3.51 billion. Earnings per share are currently negative at 2.82, so profitability remains a work in progress, but 2024 revenue reached $600.7 million. On a valuation basis, the enterprise value-to-sales ratio stands at 6.07, signaling investors are paying a premium for top-line growth and the potential operating leverage as the model matures. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Quick question: which AI-driven revenue stream scales fastest over 3 years? A programmatic CTV ad inventory or AI-automated insurance underwriting? Tell us why in the comments. So there you have it, two very different companies, the Trade Desk and Lemonade, both leveraging AI to build what I believe are incredibly strong long-term growth stories. The Trade Desk offers a more established, profitable play on the durable trend of digital advertising, with a massive moat built on data and network effects. 𝗗𝗟𝗧, the quiet giant powering the ads you see on streaming services, and its position looks stronger every day. On the other hand, Lemonade presents a higher risk, higher reward opportunity to invest in the disruption of the ancient insurance industry, powered by a superior user experience, sophisticated AI, and a lower cost structure. Don't forget to like, share your thoughts in the comments, and subscribe to the channel so you don't miss out on the next important financial investing update. Thanks for watching, and I'll see you in the next one.